What are the chances that the IRS will actually audit you? My name is Sherman the CPA, and I am going to answer this question by using information directly from the IRS Data Book. Today, you are going to learn the percentage of tax returns audited by income, how this may change in the future, and some of the best ways to decrease your chances of being audited by the IRS. If you are new to the channel, then welcome. We are all about teaching you legal ways to save on taxes and increase your wealth. So if you want to learn from our library of over 250 videos, then just make sure you subscribe to our channel. And if you don't mind, please help me get the word out about this video by simply clicking the like button below. All right, so what are your chances of being audited by the IRS? Here is the data. If you report less than $100,000 per year in income, then you have a 0.25% chance of being audited by the IRS. This is down from a 1% chance in 2010. This means that 1 out of every 400 people will be audited in this income group. If you report between $100,000 and $1 million in income, then you have a 1% chance of being audited. This is down from 3.5% in 2010. So you have a 1 out of 100 chance of being audited if you earn over $100,000. And if you make more than $1 million, then that jumps up to a 5% chance of being audited from the IRS. Now, this is down from 20% in 2010. So if you make over $1 million per year in income, then you have a 1 out of 20 chance of being audited. Now, despite the fact that audit rates have significantly dropped over the last decade, as you can see here, the IRS focuses much more of their attention on high-income taxpayers. This is because IRS audits are very costly. Therefore, they have to focus on big fish in order to increase the amount of revenue that they can collect from taxpayers. Think about it this way. Let's say it costs you $50,000 to audit someone, and one taxpayer earned $10,000 in income and another taxpayer earned $10 million in income. If you want the highest return on your investment, then you would probably go after the person making $10 million, because if you find just one error, then the returns associated with it could exceed your expenses by far. So that's the logic here. Now, keep in mind that I'm not recommending that you cheat on your tax returns in light of this. You may still be audited, and your chances actually increase substantially if you make a lot of errors on your tax return. Now let's talk about how the number of audits may change in the future, and then I'll tell you some ways to decrease your audit risk. Look, it is no secret that the IRS is severely underfunded. Since 2010, the IRS budget has actually fallen by 20% and consequently reduced its staff by over 22%. So we have less money, less staff, less audits. That's the story of how we got to where we are today. However, there are plans in place to fix this. In 2021, the Biden administration proposed increasing the budget of the IRS to direct more resources to, quote, enforce the tax law. His tax plan was not approved, and it is still not approved at the time of this video, yet there are more and more cries for IRS funding as time progresses here. We have seen delayed tax returns, delayed tax refunds, and a vast of other issues resulting from the lack of IRS funding. Therefore, if you were to ask me for my opinion on this, then I would say that it is very likely that the IRS will receive more funding in the near future, which would also mean more enforcement and therefore more IRS audits. So it is possible that the decreases we saw in the audit rates over the past decade may flip and start increasing in the decade ahead. With that said, I want to give you some tips to decrease your chances of being audited by the IRS in the first place. Here are some tips to decrease your tax return audit risk. Number 1, report your income. Make sure you report all factual income that you receive, including W-2s, 1099s, and any other types of tax forms reporting your income. Whoever issued those forms to you have already reported it to the IRS. So if you file your tax return without filing those forms, then you will likely increase your risk of being audited. Number 2, do not overstate tax deductions or tax credits. You do not want to overstate tax deductions or credits on your tax return. Some taxpayers overstate or exaggerate elements of their tax return, which may actually trigger a red flag when the IRS processes your return. So only claim factual tax deductions, tax credits, and other information that you include on your tax return. And number 3, prove it. According to the IRS, it is your responsibility to prove the items on your tax return in the event of an audit. We have had clients receive letters from the IRS simply asking for more information about an expense that they are trying to deduct. And you can easily resolve these types of examinations by simply keeping up with your documents and providing them to the IRS when they ask about it. Most of the time, the IRS is just looking for more information to verify the information you are claiming on your tax return. So keep up with all of your receipts, documents, invoices, logs, and other information that may help you prove the information you are claiming to be true on your tax return. And that's it. As long as you report the tax information you receive, refrain from lying or falsifying information on your tax return, and maintain proper documentation to prove the information you claim, you can reduce your audit risk. Drop me a comment below and let me know what you think about today's episode. And as always, thank you for watching. I look forward to seeing you in the next one.